Today what we're going to do is we're going to talk about how to make sure that when we come up with a target share price that we have a reasonable target share price and we do what I'll call a sanity check against our assumptions. And we're going to use some market data to help us do that. So these are the two sanity checks that I want to add to our model. So the first is I have a chart in our model, and I'm going to use the Whole Foods model that we had been developing called the ROIC chart. And I'm going to delete this tab because we're going to re-add it. And the idea is that if I go to the EP, and I'll use the EOY tab as an example, we have calculated both historically based on end of year ROIC and prospectively based on end of year ROIC a forecasted return on invested capital for the company. Now we know over time that ROICs tend to regress towards the average, or in this case cost of capital. So what we're going to do is we're going to create a graph. So I'm going to highlight this row, I'm going to insert a chart, and in this case, take it back, just again, delete, select the numbers. I'm going to insert a chart, insert sheet, chart sheet, that has the historical and forecast ROICs over time, right? And so what I'm going to do is I'm going to select the data, and what I'm going to do for the x-axis is I'm going to highlight the years. Hit OK. So that I now know that these are the ROICs. I'll change this to be my EOY ROIC as a chart title. And I'm going to rename the tab the ROIC chart. But this is a graph of historical and forecast ROICs. So I generally know that over a longer period of time, for companies that have above average cost of capitals, that their ROICs tend to move in this direction. If I see it continually moving up, then I may not have as much of a realistic valuation. So here's an example. Let's say that I believe Whole Foods is going to grow 12% a year, and Whole Foods is going to have a 10% EBITDA margin, and they're going to be worth $60 a share. Okay? So I'll say I believe it just as an example. So let's go back to this ROIC chart. And what you'll notice is that in the out years, the ROIC is sloping up. It's called a hockey stick, and is much higher than it's ever been historically. And that seems to be a little bit less realistic to me. So the key is, as part of your model, what you have to do is you have to be able to explain what happens to this ROIC chart over time, and it has to make economic and logical sense. And this one doesn't seem to do so, because in the out years, the ROIC tends to be getting better, not worse, and that becomes sort of a challenge for what we would know would happen to ROICs over time. So again, makes it harder to justify a $60 share price today. Not saying it's not impossible that these things can happen, but they're unlikely, and again, it's just another way of visualizing the assumptions that we make. So I'm going to go back and undo these changes. Going back to about our as-is last week, and let me talk about sanity check number 2, and it's going to come from the multiples. So on Wednesday, we had added the multiples tab into the model, and these are the multiples calculated using the RV section of Bloomberg for Whole Foods. So we went to RV, we created a custom tab for the multiples, and we exported it and we put it in the model, and I said to do it as a tab so that we could always have it to do our multiple analysis. The other reason why I wanted you to have it in the model is that what I want to do is I want to put in something called the implied multiples. And what I mean by that is that given the forecasted share price, we basically have an implied price to earnings ratio. We have an implied given our forecasted enterprise value, an enterprise value to EBITDA multiple. So basically, as we calculate a share price, we are calculating multiples. Now, these are the observed multiples from the actual market, and these are the multiples that we're about to add are the ones that our model is calculating, and we could just see how they stack up. Because the multiples that we're essentially implying from our model as we create our share price are far different than the multiples in the marketplace, not just for Whole Foods, but also its peers. And it's another check about what could we be missing about the valuation. Because multiples are an expression of growth and spread, and so therefore we have the expectation of growth and spread for this industry group. So essentially what we want to do is if we come up with a multiple that's well outside this range, then what we're doing is we're coming up with a growth spread multiple that's well outside the range, and that is another sanity check for our model. So here's what we're going to do. In the DCF tab, I'm going to start with the enterprise value multiple. The enterprise value multiple is slightly different than the one that Bloomberg calculates. And a quick way to see this is if I go to the FA section, this is the Bloomberg calculation for enterprise value, which is the one that's used in the real world. And the enterprise value is basically, if you see over here, it's the debt and equity, the market capitalization, plus the preferred, so common equity, preferred equity, total debt, or what we would call the 3s and the 4s, minus the cash, or in our case, we would say it would be the excess cash. But what they're doing is they're basically saying that assuming a company doesn't have a lot of non-operating assets, then the enterprise value is 3 plus 4 minus 2, which would equal 1, which would be the operating value. Assuming it does have some operating assets, then it's the operating asset value plus the non-operating asset value excluding cash. But again, for most people, they say that it's really another way of expressing operating value. So it's a slight different version than what we calculate for enterprise value. So what we need to do in our model is I'm going to create over here the Bloomberg equivalent enterprise value. We call it the BEV. So how do I sync up so that the enterprise value is calculated in the same way? Well, equals, if I go back to the valuation, then we have a common equity value, okay, plus we have a preferred stock value, right? Plus we have our debt value, right, which would also include the retirement-related liabilities and the minority interest. And then we would subtract all the cash. So go back to the balance sheet, take the operating cash and the excess cash. And so basically this would be what I would call the Bloomberg equivalent enterprise value. So it is the enterprise value, so the enterprise value basically minus the cash. And that's the way that Bloomberg calculates it. So now what I'm going to do is I'm going to go here to the multiples tab, and I'm going to insert a row, and I'm going to call this the implied multiples. So what are the implied multiples? Well, one, we had estimated a margin based on the multiples. So what we're going to do is we're going to put our margin from the model in this tab. So in this case, go to ratios. It's the operating income starting in 2018, which was the year that we were using the implied multiples for. So I'm going to put that here. Okay. So that's our implied margin using these numbers. Okay. Then for our market cap weighted average. Okay. So again, what we had done here, 5.24%. I'll format this as a percent. 5.2 was what the market used. 5.2 is what we kind of came up with when we adjusted the model to get the as is. Next, we have enterprise value to sales. So for 2017 equals enterprise value. So I'll go back to the Bloomberg equivalent enterprise value, and I'll divide by, on the income tab, 2017, which was the second forward next year's sales. So divided by 2017 revenue, and that would be our enterprise values to sales ratio. Then we do enterprise value to EBITDA equals, again, Bloomberg equivalent enterprise value divided by 2017 EBITDA. Okay. Then we have equals Bloomberg equivalent enterprise value divided by EBIT. So 2017 EBIT, which is operating income. Then we have the PE ratio. So basically we have the price, and it's price per share divided by earnings per share, or in our case, it would be the common equity value divided by, second forward year, 2017 net income, which is I-22. So the earnings available to common shareholders, I-25. That would be our PE that the model is calculating. And then finally, we have our price to book multiple. So equals our price, which would be our equity value, divided by, and this is current book value, balance sheet, 2015, book value of equity would be the common equity, so share capital plus retained earnings. So that would be 2015. Okay, so put a little parentheses around that, price to book, and that will be our estimated price to book using the model's calculation. So obviously there's going to be some accounting adjustments in here that make these numbers slightly off, but the point is that what we can quickly see is that we have an implied multiples. Now, given our share price, these multiples look reasonable considering the ranges that we see in the industry. So let me go back to my previous example. Again, let's say we have 12% growth per year, and we have 12% margins. I'm now at an $80 share price. I go over here to my multiples and I see, well, that's an implied margin of 9%. No one in the industry is making 9%. That's an EV to sales of 1.52. There's no one in the industry close to an EV to sales of 1.52. That would be an EV to EBITDA multiple of 18.15. No one in the industry is even close to that. That would be an EV to EBIT ratio of 27.5. That would be a PE of 46, and that would be a price to book of 6.93. So when I look at this and I look at my ROIC chart, I can quickly see that this just doesn't seem like a reasonable share price for the company, given what the market is viewing, not just Whole Foods, but all of its players. So what you're going to need to do for your model is basically make these adjustments and have that ready for your project. So for your valuation, whenever you do a company, you'll do your target, and when you do your final target, you then have to basically defend these two sanity checks. One, you got to show me the ROIC chart and tell me why this is reasonable. And two, you got to show me the implied multiples that your valuation would imply against the range of possibilities of the industry and justify that as well. That concludes this section.